Hello everyone and welcome back to Bitcoin Legacy. Today we're covering a major development shaking the crypto market. Bitcoin has slid below the $83,000 level, touching lows near $81,200 as Wall Street investors pulled more than $1 billion out of crypto ETFs in a single day, following the Federal Reserve's decision to pause interest rate changes. This move has triggered a broad risk-off reaction across crypto, equities, and even commodities, raising fresh concerns about liquidity, institutional sentiment, and the sustainability of Bitcoin's recent price structure. In this video, we'll break down why Bitcoin dropped sharply after the Fed pause, what ETF outflows really signal, how forced liquidations accelerated the sell-off, why gold is outperforming Bitcoin, the role of liquidity, miners, and macro risk, and what key price levels traders are watching next. So make sure to watch till the end. Bitcoin slid as low as $81,200 on Friday, marking its weakest level since November. This drop extends a pullback that began earlier in the week after the Federal Open Market Committee opted to keep interest rates unchanged, signaling patience rather than urgency toward further easing. At the time of reporting, Bitcoin is down roughly 3% on the day. Ether, Solana, and XRP are each down between 4% and 6%. The broader crypto market is following Bitcoin lower. While crypto markets initially absorbed the Fed decision calmly, selling pressure intensified as U.S. markets reopened and risk sentiment deteriorated across asset classes. This confirms once again that Bitcoin is increasingly trading in sync with global macro conditions, rather than in isolation. One of the most critical drivers behind this move was ETF selling pressure. According to data from Soso Value, U.S. investors withdrew over $1 billion from major crypto ETFs in just one day. This included spot Bitcoin ETFs, spot Ethereum ETFs, Solana ETFs, XRP-linked products. These redemptions mark a clear shift in institutional positioning, as large investors reduced exposure to risk assets following the Fed's cautious tone. Importantly, ETF flows often act as a sentiment indicator, not just a volume metric. When ETFs experience sustained outflows, it suggests reduced institutional conviction. It removes steady spot market demand, and it increases downside volatility. This wave of selling reinforced the idea that institutional investors are prioritizing capital preservation, not aggressive risk-taking, at least for now. The price drop was further intensified by forced liquidations. According to CoinGlass, more than $1.8 billion in leveraged crypto positions were liquidated over the past 24 hours. The majority of these liquidations came from long positions, highly leveraged retail traders, short-term speculative bets. As Bitcoin broke below key support zones, stop losses were triggered, margin requirements tightened, and positions were automatically closed. This created a cascade effect where falling prices caused liquidations. Liquidations caused more selling. Selling pushed prices even lower. This type of leverage-driven sell-off is common during macro-driven market stress and highlights how fragile short-term positioning had become. Another major talking point is Bitcoin's underperformance relative to gold. While Bitcoin has fallen roughly 20% over the past year, gold remains up approximately 82% during the same period. Even during this recent sell-off, Bitcoin dropped sharply, gold corrected, but still maintains strong long-term gains. In fact, gold's recent pullback wiped nearly $4 trillion off its market capitalization, yet it continues to attract capital as a defensive asset. This divergence reinforces a key narrative. In times of uncertainty, investors still treat gold as a hedge, while Bitcoin remains categorized as a risk asset. According to Thomas Perfumo, global economist at Kraken, the core issue isn't interest rates alone. It's liquidity. He emphasized that global liquidity remains tight. Rate cuts in 2025 have lowered borrowing costs, but broader liquidity conditions haven't meaningfully improved. Liquidity affects crypto more than almost any other asset class. When liquidity is abundant, risk assets rally, leverage expands, crypto thrives. When liquidity tightens, risk exposure shrinks, volatility increases, crypto underperforms. Perfumo also noted that Bitcoin's evolution into an institutional asset has reduced extreme volatility. But this dynamic is not permanent. Stabilization in long-term holder behavior and regulatory clarity could eventually restore confidence. Short-term positioning has also weighed heavily on Bitcoin. Matt Howells-Barbie, vice president at Kraken, highlighted growing concerns over heavy AI spending by major tech firms, valuation risks in U.S. equities, extremely tight credit spreads, markets entered the week overweight risk, and any sign of instability triggered repositioning. Bitcoin once again felt the impact first. According to Howells-Barbie, a failure to reclaim the $83,500 level keeps the $80,000 region firmly in focus. This makes upcoming price action especially critical. Beyond macro forces, on-chain data reveals stress in Bitcoin's mining sector. A recent CryptoQuant report showed that severe U.S. winter storms disrupted mining operations. Several large miners reduced production. Bitcoin's hash rate dropped by roughly 12%. Daily mining revenue fell to a yearly low near $28 million, driven by lower prices, slower block production, rising operational costs. Although conditions are beginning to normalize, miner profitability remains under pressure, which historically adds short-term selling risk to the market. Bitcoin has recovered slightly above $82,600 ahead of the U.S. market open. However, it remains on track for a fourth consecutive monthly loss, facing its longest losing streak since 2018. Key levels to watch: resistance, $83,500 to $85,000. Support, $80,000 psychological zone. Failure to reclaim resistance could invite deeper consolidation, while a break above could stabilize sentiment. Conclusion, 2 to 3 minutes. To summarize, Bitcoin's recent drop is not driven by a single event, but by a convergence of macro pressure, liquidity constraints, institutional outflows, leverage unwinding, and miner stress. While the long-term thesis for Bitcoin remains intact, the short-term environment favors caution, patience, and disciplined risk management. As always, volatility creates opportunity, but only for those who understand the broader picture. If you found this breakdown helpful, like the video, subscribe to Bitcoin Legacy, and turn on notifications for daily crypto market updates. Thanks for watching, and I'll see you in the next one.